indeed. Anand Shah is now joining us. He's head of PMS and AIF investments at ICICI Pru Asset Management Company. Anand, great to have you with us here. Thank you very much for your time as always. Let's just start with the latest or the last changes that you've made in your portfolio, what you can tell us, that is. Not that you're working on right now, but what you've already effected. That'll give us clues to your thinking. Go on.
Hi, very good evening. So I think very clearly, if you see the results that have gone by and the strength that we are seeing already, I think banking still remains the area where the earnings growth rate has been strong. But not only that, even the outlook for that sector remains fairly optimistic, given the entire manufacturing pack, which we have been for a very long period of time being very positive, because that's also one big part of banks' NPA book, infrastructure, the manufacturing. And as that looks up, as that continues to do well, we are also seeing fairly good resolutions coming. So overall, not many changes been made on the portfolio side of late. But if you ask me, what's been outcome of the FY23 results, fourth quarter results, I think we still remain fairly constructive on a B2B part of the economy, notwithstanding there is a slowdown in US and Europe. But the domestic markets look strong. Exports, we believe, will pick up. And to that extent, B2B and the allied businesses like corporate banks remain fairly comfortable when you look in context of the valuations at which they are.
From all your portfolios that we know of right now, at least the top 10 holdings for all your portfolios, one of them is the consumer space, the other one is the IT space. Now, both these sectors haven't done much in the last year or so, barring a couple of stocks. ITC, for instance, has taken the FMCG index higher. But, in your ACE portfolio, you have two retail names, and that's interesting. You have Trent and you have Avenue Supermarts. Both these stocks made news last week. Trent after, the way Zudio has grown, and Avenue Supermarts, when there was an upgrade coming in from a brokerage, they believe that now the valuations are palatable and the prospects for next year look good. What are your thoughts on the retail space in India?
Indeed, within the B2C space, we've been very, very selective, and consumption as a whole has been doing extremely well, especially pre-2020 when the inflation was fairly benign. Consumption stocks not only benefited from a low inflation, but also by virtue of being brand owners and had some pricing power. So I think valuations were not cheap to start with in 2020. So we've been sort of more, as I said, overweight B2B, underweight B2C. And within the B2C, we've been very, very selective, the consumer-facing businesses. One of that area has been organized retailing. I think the organized retailing is here to stay. While it did have some sort of disruption during the COVID period, and even before that, as a lot of online e-commerce businesses came up and had a lot of money to burn, and to that extent, they also gained significant market share. But the businesses which could survive both the disruptions, the e-commerce disruption as well as the COVID disruption, actually are coming back very strongly. Having said that, they've also cut the cost, became more competitive, and some of them are actually going ahead and also benefiting from the online strategy. So I think organized retail is here to stay, here to grow faster than the overall consumption growth rate, and we will have to continuously be watchful of the valuations. So no doubt, these businesses are not undiscovered stories. These are the companies which are well discovered, and to that extent, valuations will always be a challenging here. But nevertheless, we will have to weigh it every quarter.
Okay, got that. Anand, hi, good afternoon, Surabhi here. So I was noticing something going through the portfolios, whether it is the flexi cap strategy or, some of the others that you have, that a lot of banks make it to your top holdings, whether it's an HDFC Bank or a BOB or, some of the others. But at least in the top holdings list, NBFCs or insurance or asset managers for that matter, the other side of the non-lending side of financial institutions, that was kind of missing. For instance, I didn't see digital lenders or a Paytm. So what's the thought? Why you'd be convinced of banks is one part of it, but what's your view on the non-lenders or the non-bank lenders, so to speak?
Sure, I think banks gives you the perfect play on both asset and liability side. So as you rightly said, the life insurance and the asset management plays on the liability franchise of the banks, or NBFCs would be more of an asset franchise. With banks, you get to play both liability advantages as well as asset. So if you recall, in the early phase of March 2020, June 2020, around the early days of COVID, actually the insurance companies were bought, and any NBFC or a bank which actually had assets on its book suffered or was sort of at a lot of risks. But if you see more recently, and as I've been I said a while back, that actually the asset side of the book is looking better. While you had a significant long periods of pain post asset quality review and through the Demon, GST, RERA, and the NBFC crisis, the banks had to provide year after year for the NPAs. What we are seeing more recently is, one, the existing book is stress checked and to that extent is behaving fairly well. But even from your back book of NPAs, you are able to get recoveries also. So I think banks are, the way we see, is better poised relative to the other pieces also in terms of valuations. That you have low cost liabilities with you, at the same time asset side of the business is also providing you good profits. So that's how, on the risk reward basis, when we evaluate entire BFSI sector, we still find some banks being far better off than the others.
Anand, I saw a couple of textile names as well in your portfolio. This space is doing very well. There are apparel makers like Gokuldas Exports, yarn companies, Vardhaman, Indocount, Himmat Sinka seems to be doing very well in the last couple of weeks. Seems to have picked up. Something changing there, or what are your thoughts? And which ones do you like? I mean, what segment do you like rather?
I think a lot of manufacturing, including the cotton, textile, yarn value chain or metals or others, they actually were big beneficiaries in the early phases of 2021, 2022. As your competition from China, which was very, very stiff competition pre-2020, has ebbed. Very clearly, China's competitiveness in the commodity level of manufacturing has reduced. But so be it, it's while it's a structural piece, cyclically China will keep on having over capacity, which we saw last year when they had a severe lockdown. And to that extent, many commodities, we saw a resurgence of exports out of China into the rest of the world, including India. I think what we are seeing more recently is while China opened up a while back, we will see slow and steady recovery in the Chinese economy and the consumption. And to that extent, that's the one piece which will reduce a lot of pressure on the global commodity prices, as China, a very large economy, second largest economy, will start picking up in terms of consumption. The other thing which we noticed more recently is also India's textile also suffered last year significantly, as the India's cotton was significantly more expensive than the global cotton. I think that's also corrected in this season. And to that extent, the competitiveness the Indian cotton yarn manufacturer, or all the way up to apparel, the entire value chain has improved as the cotton prices have corrected to more reasonable levels and more relative to the global cotton prices. So I think these are the couple of things which might be the reason. But overall, the way we are seeing is India's manufacturing continuously have an opportunity, if you have a right business, if you have a right to win, to continue to do well for a few years, as China's competitiveness in commodity manufacturing will keep on going down.
Just want to point out, these are interesting updates coming in from Tata Motors. What they've done is they've made an exchange filing. There's an investor presentation, a JLR investor presentation that's just been uploaded. And it's stating some interesting points. Some of it we know already. For instance, their promise of delivering £2 billion of free cash flow in the current year, FY24. I just wanted to do a comparison in terms of how much of an improvement that would be. This one part, the 2 billion free cash flow, is actually known. Their free cash flow numbers were much, much lower, just £521 million in the year that closed, FY23. What else is Tata Motors saying? The margin promise is pretty significant if they manage to deliver it. 6% EBIT margin. This is JLR, all JLR data that I'm talking about. 6% in FY24, 10% by FY26. They rounded off FY23 with just about 2.5%, I think. Yeah, FY23 was 2.5%. They're saying this year, 24, they'll touch 6% and 10% by FY26. Some pretty interesting updates coming in from the investor presentation. And net zero debt, net cash positive by FY25. So a lot of the promises from the JLR team there being made in the investor presentation. Just thought I'll point that through, Mangalam. Tata Motors, I guess the stock has had a humongous rally, right? So, which is why it's not shooting through the roof. A lot of that perhaps already in the price, and the market will want to see the delivery on these promises now.
Yep, they will. And interestingly, it's the one auto stock which is not there in Anand's portfolio or across the portfolio, because I was looking at it. The two motor names that he has, one of them is Maruti, which is a part of their ACE portfolio, and the other one is TVS Motor. TVS Motor, Anand, is at a record high. That stock as well. Your thoughts on both, Tata Motors, TVS Motors, and Maruti? Why you prefer Maruti and TVS to the other names that are there?
No, obviously, I can't talk about the stock-specific ideas, but nevertheless, since you've asked, I think the overall outlook for India's auto angs, and as I said, generally for manufacturing, the way to see is there are many moving parts in the auto industry. To be very honest, it's not a straightforward. I think the big risk that exists for the Indian auto industry, or for that matter, global auto industry, is the EV risk. I think one need to be very, very careful with the auto stocks that one owns, that are the ones which are really prepared for the EV disruption, or rather they are going to be the participant to the EV disruption. Because if you're not, then there's hardly any terminal value for auto business if you don't have an EV strategy. So I think that's one very important risks that exist. What also it does is also it creates a very new dynamic. So Indian auto industry is also fairly consolidated. We have leaders in many of these segments where an individual company has a very large market share. What EV does is also it allows a new entrant to come in at the same level playing field with the existing incumbent. So there are a lot of risks to the incumbent auto companies in India, even with the technology at this.
All right, Anand, thank you for joining in. Always a pleasure speaking with you. Thank you for taking us through your investment rationale across sectors. With that, we'll step into a short break. On the other side, as always, we'll get you a check on what the reading groups are saying in our D Street Chatter segment. Also get you buy today and sell tomorrow calls from Mitesh.